going to have a sampling exam review. We'll have the sampling exam later on. Okay, so Chapter 6 handout. Okay. So this is sort of the entire overview of the audit. And we're on this first phase here, planning the audit. You know what? Hold on a second. Oops, hold on. Okay. I don't know why I made it all red. Planning the audit. So this is sort of like the first step, and this is how you plan on getting your, how you plan on getting the information you need to, in the end, form an opinion. So how do you get from planning to forming an opinion? And you have to get an understanding of the client, including their internal controls, which is required. Assess the risks. And from the risks, you will perform a further audit procedure. This is where we do the sampling. So sampling, the stuff that we did in sampling, this comes in here. There's other things that go in there too, but these all come from the risks up here. I got everything in yellow. Let's make it green. So basically, you get an understanding of the client, and then once you get an understanding of the client, you go, okay, what could go wrong? You know, what are the things that could go wrong on this audit as far as risks are concerned? And from those risks, you then make a plan. I go, okay, well, how do we mitigate these risks? How do we reduce the likelihood of these risks? So that's what we're talking about when we get to the sampling. If we think there might be a problem in some of the accounts, we do a sample of those accounts. Completing the audit, there are some more procedures that we do. This is actually Chapter 16, which we'll have later. And then lastly, we get enough information to form an opinion. This is Chapter 17. Our procedures, this is Chapter 5 mostly, and Chapter 9. Okay, those aren't capitalized. Okay, there we go. Okay, so this is what we're going to start doing. Okay, so which of the accounts is the easiest to prove? There's 5 different categories. We have revenues, expenses, assets, liabilities, and equity. So those are the 5 types of accounts that we have. Which one is going to be easiest to prove? I'll give you a hint. One of them you can see. The rest of them you can't.
Assets?
Yep. Yeah, we start our audits with assets generally. Oops, not like that. Because they're the easiest. Right? So if they have a, inventory, we can go count the inventory. We can look at the equipment. We can get bank statements. For the cash, I did something wrong here. So it's easy. This is the easiest. The easiest ones are the assets. There's actually things we do with accounts receivable. We'll talk about in chapter 5. But these are, the easiest to prove are the assets. Many of them you can go visit them. You can look at the equipment. You can look at the property, plant, and equipment, and all that kind of stuff. Inventory, supplies, all that. You can go look at it. So we start out with assets. The next one are the liabilities. And there's various ways we look at liabilities, but for one thing, the bank will have us. Oftentimes, will have the liabilities on there as far as what's owed to the bank. They'll have loans and things like that. Accounts payable, you can look and see what was shipped to those people for the accounts payable. You can also do confirmations on those. Long-term payables, things that they pay in the long term. Another thing for liabilities, another way that you can detect liabilities is see what's being paid. Right? If there's payments to liabilities on the books, well, that indicates that the liabilities are there. So if you have a long-term mortgage or something like that, one piece of evidence is, are they paying cash to a bank for a loan, or some other institution for a loan, that sort of thing. So you can actually prove the liabilities. Now, notice the beauty of the balance sheet having to balance, because if you know the assets are okay, and you know the liabilities are okay, what else do you know? What else is okay by default? Because this thing's got a balance, right? Assets have to equal liabilities plus owner's equity. I don't know if I have room here or not. Okay, so we know that assets have to equal liabilities plus equity. So if we know that assets are okay and liabilities are okay, we also know what? What else is okay? Oh, you guys are toying with me. This is so obvious. If there's no problem with the assets and there's no problem with the liabilities, that means there's no problem with
stockholders' equity.
Yeah, exactly. If 1 and 2 are good, then the equity must be okay too, because if this is okay and this is okay, then whatever you have for the equity to make these balance must be okay. And now the equity through retained earnings has dividends and net income. So it's a pretty good indication that these two are okay too. Now, it could be that there's a problem with, say they've increased the revenues and increased the expenses, but the net income should probably be pretty close. Okay, now there's one more thing here that we should look at, and that is, first of all, I should be making everything the same color. Let's take cash. Cash is an extremely important account, and the reason why cash is so important is that everything goes through cash. Eventually, almost everything goes through cash. You almost have to get creative to think of a transaction that doesn't go through cash. If you sell something on credit, eventually they pay it. It goes through cash. If you buy a piece of equipment out of the loan, it goes through. I mean, and you got to get really creative. Maybe like trading land for stock or something like that. to find a transaction that doesn't actually go through cash is kind of strange. So everything goes through cash. So while we're proving the cash, we can very well be proving all these other accounts. Now, the cash account is oftentimes not very big compared to the rest of the stuff. You have these buildings and these, inventory and all this stuff are really large numbers. A lot of times the cash isn't that big. So you're tempted to look at the cash and say, well, gee, cash isn't that important. Maybe we don't even need to look at it because it's not material. However, because so many accounts go through it, it becomes material. And I'll show you what I mean here. For instance, let's take, I'm going to put this on the side. Oh boy. All right. Let me insert other shapes here. Okay. If you make a sale for cash, right, it goes into cash. And they say, well, how about if you make a sale on credit? That doesn't go to cash. It goes to accounts receivable. And when they pay the accounts receivable, it goes to cash. Right? Okay, and you say, well, how about inventory? Well, if you pay cash for inventory, I should probably use a different one, but I'll do it in 2 steps here. If you pay cash for inventory, it goes through cash. You say, well, what if I don't pay for it? What if I pay it on, I buy it on credit? Okay, it goes to accounts payable. Accounts payable then goes to cash. You pay it off. And you get the idea. Equipment, same thing. You bought it on credit, it's going to go through cash. All these payables eventually go through cash. Your expenses all go through cash. So even though cash, and even if they go through accounts payable, the accounts payable comes back through cash. All of these things, a great number of these things are going to come back through cash fairly quickly. And so because even though cash is maybe not technically a material amount, maybe it's immaterial, you'll often do an extensive audit of cash for a couple of reasons. First of all, everything goes through cash, and that's probably the most important reason, is that everything goes through cash. And it's strange if something doesn't go through cash. Another thing is that cash is something that everybody can use, so it's also maybe one of the more vulnerable assets, and that everybody can use it. If you're a company making hog feed, stealing hog feed probably is going to be difficult. To get enough hog feed to steal is probably going to be even more difficult. But the cash, you can always use that. So it's one of those things that's more vulnerable. Also, something about cash is that most times, you can audit cash to 100%. You can get bank statements. And if they have petty cash, usually petty cash isn't material, but if they do have petty cash that is material, you can count the petty cash. You can oftentimes audit cash to 100% or pretty close to it. So, for those reasons why everything goes through cash. Right. Let me put another document out. Maybe a better way to do it. So why is cash so important? Okay. I'll stick it down here, I guess. Cash is important because most transactions go through cash. it is most universally valuable asset. You know, it's already converted in fraud language. It's already converted into cash. And three, usually we audited 100%. So this is why cash is important. Most transactions go through cash. Is the most universally valuable asset, and maybe the most at risk, a higher risk than most. Like I say, if you're a company making hog feed has a value, but it's hard to transport and it's probably even harder to sell. So, whereas the cash, anybody can use it. And usually it can be audited 100%. You can get all the bank statements. Even large companies, a lot of times you get all the bank statements. So for these reasons why we, even though the cash account itself might be immaterial, we really concentrate on cash for a good chunk of the audit. Any question on that? Okay. Auditing risks. All right. Let's go through these. So these are the risks that you have to look at to know what to audit. And you don't just audit everything, just jump in and audit everything. One of the things you do is you sit down and talk about what could go wrong. And when I was doing internal auditing, we actually did pretty extensive audits, more than the CPA firms. We looked at everything. And I remember just sitting down with the audit manager, and we would just go over, well, what could go wrong, what could who could possibly do something wrong here, and or what could go wrong just in the system itself. We sit down there, and then we say, after we got all these things that could go wrong, we kind of felt were had a possibility of going wrong. Then we started just saying, okay, well, how do we test it? Sometimes it was really obvious what you'd have to test, and sometimes it wasn't. Like, I don't know. How would you know if this? Okay, if this wasn't getting into the process, here, how do we know that? So sometimes it was difficult. Sometimes it was very straightforward. But anyway, you get all these risks down, and then you, from that, you'll make up your what need to be audited. So here's how we kind of break up these risks. And the first two are by the client. So this is a client risk, and this is the risk of material misstatement. The risk of material misstatement. Oh, need another R in there? I do need another R. Okay. The risk of material misstatement occurring. So what is the likelihood that there will be a material misstatement and it will occur? And again, this is the client. Their client's people, they're working throughout the year, and the risk of material misstatement occurring. What is the risk of it? Control risk. This is again the client. That the client's controls will fail to identify or prevent a material misstatement. I'll clean this up in a second. Let's see. Oh, we should have done this first. Go. Okay, so the control risk, again, this is the client still, that the client's controls will fail to detect or identify or prevent, I should say. A material misstatement. So, okay, so the first one is will it occur? Second one is will the client miss it? Yeah, maybe I'll separate these out so it's a little easier to see. Okay, detection risk. Oops. Okay, so let's think about this for a second. So the client, so the inherent risk is the risk that a client will have a material misstatement. The control risk is the risk that they will fail to detect the material misstatement. So first one is will it occur? And this has to do with their training and all this kind of stuff. Will they make a mistake? The second one is, okay, if they do make a mistake, will they catch it? Will the controls either keep it from happening in the first place or keep it from going into the system, or will the controls identify it? If it did go into the system, will it identify, oh, by the way, this is wrong, this mistake. So now, if the client fails, it's up to the auditor, right? So as the external auditors, we're the last hope. If it gets past the client, if it occurs, gets into the system somehow, and it doesn't get kicked out by their internal controls, then it's up to us. So this is detection risk is the auditor. There's that the auditors will fail material misstatement. So if it gets past the client, so here's the client. Oops. Hey. Oops. Sorry, I just sneezed. All right. The client gets by the client. Then the last hope is that the auditors get it. Oops. I don't want to make the auditors different color. Let's make the auditors green. Okay, now if the client fails and the auditor fails, that is the audit risk. So the audit risk is the risk that an undetected material misstatement appears on financial statements. Okay, so if everybody fails, that's the audit risk. The audit risk is the risk that an undetected material misstatement will appear on the financial statements. Now, it's possible you detect the material misstatement and it's still on the financial statements because the people aren't correcting it. So that is a possibility. But that's the overall audit risk. Okay, let me, what a beautiful chart that is. I'm surprised they don't have that in the book. All right, I need some space. I'm gonna come down here for this one. Okay, there is a mathematical formula for determining audit risk. And it's been on the CPA exam, I know, at least it's been on, certainly it's been on twice. It probably has been on there more. But basically you multiply the risks together and you come up with an audit risk. So let's say that we have the example down below, the inherent risk. So this is the risk that it will occur is 40%. The control risk is that the client's controls fail. And the 20% is that the auditors fail. Okay, so inherent risk is the risk that it'll occur. Control risk is the risk that it will, the client's controls will fail, and then the detection risk. So this is what this would look like. Okay, so here's what we do. Inherent risk, in this case was 40% times control risk was 50%, probably kind of high numbers, times detection risk was 20%, and this will equal our audit risk. Whatever that is. My calculator. What is it? 40 times 50 is what? 20? Is it 0.04? I think it's 0.04. 0.2 times 5 is point. Yeah, I think this is it. Because this would be 0.1, those two, and then 0.4 times 0.1. I think this is it. So this would be the audit risk. Is that what you guys got? Hopefully. I want to say one more thing about it, about this inherent risk and control risk. The auditors have no control over inherent risk or control risk for a couple of reasons. But, and I'll talk about those in a second. The client is the only one that can control those two. And at the end of the year, even they don't have any control over changing those. Why? Because if there was a control deficiency that happened in August, you can't jump in the time machine, go back and change it. Right? So an auditor does not have control over those two. Inherent risk and control risk are beyond the auditor's control. Sometimes you'll see CPA questions, they'll say the auditor should reduce inherent risk. You know, that's a bad question. You know, that's a bad answer because you can't jump. You know, first of all, they're not your controls, they're the client's controls. They're the only ones that can change it. Second of all, you can't jump in the time machine, go back and say, okay, in February, let's change these controls and then start the year over again. So inherent risk and control risk are not controllable. Now, as auditors, we assess them, and you might change your assessment of it. Maybe you think that, you know, the assessed inherent risk was 10%. Maybe because you do some testing, you think, okay, maybe it's a little higher than that. Maybe it's 15%. But you're simply assessing it. The actual, whatever it actually is, you have no control over. The only thing you have control over is the detection risk. Okay, so let's go back here, and I'm going to clean this up a little bit. So inherent risk. Control is being a bad thing. Cannot change. How about this? So the auditor cannot change. Now they can change their assessment of it, but they can't actually change what it is. And same thing here. Ooh. Hey, you know what that is? That's our it's our Zoom meeting. Oh. Now this, the auditor can change. So should make this the same as the other ones. Actually make it different. Ooh. I don't know. We'll make it so the auditor can change the detection risk. And so, and you guys kind of know this. This comes from that, you know, we did the sampling where you do, okay, we're going to sample at 90% or 95% or whatever it was. We have control over that. So we can, the detection risk, we can have control over. The, from a blank. Inherent risk, thank you. The inherent risk, oh here, when I have an idea, this is what I'm gonna do. I bought this at the dollar store. So when I have an idea, just like this. Hey, I got an idea, you know. No, with the inherent risk and the control risk, we have no control over. And actually, you know, we say as auditors, we don't have control over it, but even the client doesn't, because if it happened previous in the year, there's nothing they can do about it. So, those two don't have control over, but the detection risk is the only thing that we have control over. Okay. So this one, the auditor can change, is the detection risk. And so this is what this is basically what the audit is. You know, the detection, how you know. By the way, if there is an intentional fraud, what happens to the inherent risk and the control risk? And this is actually an important idea, and I'll tell you why in a second. So suppose that we have an intentional fraud. Management has cooked the books. They materially misstated their financial statements. What happens to the control risk, the risk that the material misstatement will occur? And what happens, excuse me, an inherent risk, what's the risk that a material misstatement will occur? And the control risk, that the controls will detect it. If there's an intentional fraud, what are the risks that those will fail? I'll give you a hint, it's very high. Okay, I'm gonna take the lights out. If you guys don't do that, I'm gonna put the lights back on. Hopefully this will make you guys, you know, answer the question. Okay. Cruel and unusual punishment. What would be the control risk? Excuse me, the inherent risk and the control risk if management intentionally materially misstates the financial statements?
Would it be 100%?
It's 100%. That's exactly it. Yeah, these go to 100. And notice what happens. If these go to 100, if you're not aware that management is cooking the books and you plan your audit at 20%, it becomes fairly likely that you are not going to catch it. There's a 20% chance, which is huge. But even these numbers seem kind of large. But there's a very real chance that you could miss it. You know, if you think it's this, when really it's 100%. Because significant, and even these are kind of high, or actually very high. But if these go to 100, when you have a fraud, these go to 100%. This is why fraud is so hard to catch. If it was simply a mistake, usually a mistake will get caught. If I'm putting in if I'm putting in a stapler, let's say, or scissors, here's my scissors. I don't know how much these cost, but suppose I got my scissors here, and I buy scissors, and instead these cost $6, and instead of $6, I put in that these cost $6 million. Right? A material misstatement. I put it in. The $6 million scissors go into the system, and for whatever reason, the system doesn't catch it initially. Usually, it'll be caught somewhere, even if the system doesn't catch it. Because someone's going to have their budget. They're going to say, well, where's this $6 million scissors coming from? And then they'll look into it and see where it comes. So it's very unusual to have errors of material misstatements that are undetected by either the system or even kind of secondary things like people reviewing their budgets or something like that you don't catch them. So a lot of times if there are material misstatements that are in the system, they're there intentionally. And that creates a real problem, because you have to audit to a higher level. One of the big changes at Sarbanes-Oxley is that this requires company or auditors to consider the possibility of fraud. And you say, well, of course they would. Why do they put that separately? They put that separately because if there is fraud, it goes to 100%. The inherent risk and the control risk goes to 100%. So they have to consider if there could be fraud, because that's going to change how they do their audit. And they're required to. In the past, they didn't say that. They'd say, okay, misstatements are misstatements. Whether it's fraud or error, doesn't really matter. You're just looking for misstatements. Now they say, okay, wait, fraud is harder to detect. It's harder to detect because of A, it's intentional, B, a lot of times they cover their tracks. These are smart people usually. A lot of times they're people that came out of auditing. So, it's a very dangerous thing when you have management fraud. And much more dangerous than simply someone making a mistake. Okay. Client acceptance. One of the strange things about auditing is, there's a few strange things about it. But one of the strange things is that you don't just audit anybody who wants an audit. You pick and choose who you'll take on as a client. If they're, of ill repute, you don't want to be caught up in a fraud or something like that. But also, even if you say, okay, I know they're of ill repute, we're going to really bump up the audit because we know this, right? We can do this. The problem is, associated with people of ill repute, remember, the only thing that we give to the financial statements are credibility. So if you have a client with a bad reputation, basically you'll be taking away the credibility from theoretically all audits, but certainly of your own audits, that, okay, wait, this guy is also doing the audit for this, person of ill repute. Now, so we pick and choose who we do. And there's a number of reasons why we do that, and we'll talk about those in a second. But, we don't just give an audit to anybody who comes by. If someone walks into Burger King and orders fries, they don't care. Whoever they are, they order the fry, they pay, that's it. And there are people that kind of think that's what they do with auditing, but they actually don't. You have to really determine whether you are able to or want to take the audit. Okay, is a CPA firm qualified, and can the audit be completed? If the CPA firm does not have experience, they can still take the audit. If they can become expert enough to complete the audit. Okay, that's a kind of wordy. I'll talk about it. It's not that bad. Okay, so let's say that you are auditing a flower shop. Okay, so you're trying to audit a flower shop, but you never audited a flower shop before. And flower shops, they have flowers coming in and going out. And the condition of them is probably very important. And quite honestly, I don't know what goes on in a flower shop. I'm just kind of talking here. But suppose that you don't have expertise in whatever the field is. If you honestly believe that you can become an expert or become an expert enough to complete the audit, you can still take the audit. And notice that if you didn't have a client in that field, it would be kind of silly for you to be an expert in that field, right? If I don't have any clients who are florists, why would I become an auditor of florists, right? So until you get that first client in that field, you're not going to be. You would never get into that field because you don't just randomly pick a field to be an expert in. So you can still take the audit, even if you don't have expertise in that area, as long as you believe you can get the expertise. And it might be hiring somebody who's done those kind of audits. I got a friend who did that, or and bring them in as a consultant or something like that to help you get through it. And then once you learn it, obviously you'll be set that you can take more clients on like that. But you do not have to be an expert in that field to take it. And until you get a client in that field, you probably wouldn't do that. Okay. Legal and ethical requirements. This is kind of what we talked about in Chapter 3. And the big one being independence. Lawsuits, we talked about that in Chapter 3 too. But independence is a large one. We have to be independent from the client if we're not, from other clients, lawsuits, and so on. And this is one of those things, again, this is one of those quirks about auditing that's different than other fields, in that we have to be independent. And sometimes people don't get that. They you're my brother. Why are you're not going to do my audit? I can't do your audit. I'm not independent. So the independence is probably one of the larger ones, and it's one of the larger ones they test for on the CPA exam. But if you have other clients that are competitors, or if you have lawsuits with clients, or clients that have lawsuits with each other, those are also problems. We talked about that in Chapter 3 also. Okay, number 3. What time is it? Oh man, I'm taking a lot longer on this than I thought. Okay, integrity and reputation of the client. According to the AICPA, this is probably the most important. They really, really hammer about the integrity and reputation of the client. You cannot be associated with people who are of ill repute. So you have to do a lot of background, and to be honest, at some point you have to trust the client. At some point you have to have some kind of trust in the client that they are actually trying to do what they're trying to do. So the integrity and the reputation of the client is extremely important, and the AICPA will tell you it's the most important. Okay, now if they had an auditor previously, the successor auditor is the new auditor. And the predecessor auditor is the old auditor. So if you're coming into a situation where they've already had an auditor, the successor auditor is the new one, and the predecessor is the old one. And the CPA questions they'll ask you are successor auditor and predecessor auditor. Okay, contact the predecessor auditor if they exist. Now, the successor auditor must get permission from the client and the reason being is, well, what do you think? Why do you have to get permission from the client to contact the predecessor? Why don't you just call the predecessor auditor up? Why can't you just call up the predecessor auditor and say, hey, what can you tell me about ABC contractors or whatever? Why can't you do that? Anyone? Oh, come on. Why can't you just call them up? Hey, what do you think about these people? No ideas? All right. Well, you don't get called up because of lawsuits. You have confidential information. And the predecessor auditor will say, look, I can't tell you anything until you get a release from the client saying that you can talk to me. Until that happens, I'm not going to say anything because I can get sued because this is confidential information. So the predecessor auditor has to get the client to agree to let them talk to him. Now, suppose the client says, I don't want you talking to those guys. Those guys are jerks. They're complete jerks and they're idiots, and I don't want you talking to them. You still have to talk to them. And you tell maybe they are idiots, maybe they are jerks, but you need to be able to talk to them for a number of reasons, which we'll talk about in a second here. But so if the client refuses, it's like any time a client refuses to give you information. The second they refuse, it puts up a red flag. You have a murder investigation, you come to my house, and I say you can look anywhere in the house except in the closet over here. Well, the closet's the first place you want to look because that's what you don't want me to look at. So it's kind of the same idea that if somebody is trying to keep you from getting information, that is kind of a red flag. So you tell them, look, maybe they are jerks, but we still have to give permission to talk to them. Can it happen where you don't get permission? If there's something unusual that happens, like let's say the predecessor auditor died or left the country or something, it's possible that they're not available. But in general, you do have to get it. Okay, these are the things you talk about. There's an 8K report if it's an issuer, if it's a publicly traded company, they fill out an 8K report. I think I'll bring one in. I'll show you what that is next time. I'll show you what an 8K report is. An 8K report is basically anytime something changes in the company, file it with the SEC. But these are just the questions you go over. Integrity of management. How are they? Reason for the change of auditors. It could be that the auditors didn't want to go on with it. It could be that the company didn't want to go on, or the client didn't want to go on with it. Disagreements. What were their communications like with the board of directors? What were their communications like with management? And related party transactions or unusual transactions. Okay, so these are all things you want to talk about. And related parties was somebody in the company. A lot of time on privately held companies who run into this. You have like car loans to grandma and stuff like that. But basically, you're looking for those transactions that are not at arm's length. I sound like Rudolph. You get the thing in his mouth. All right. Third parties, bankers, lawyers, you'll talk to those, and you'll get access to their lawyers and all that stuff that you can talk to them about. Background searches, those are common nowadays that you can actually get quite a bit of information. E is an important one, and the client continuance. Shopping for accounting principles is when the client tries to find a firm that will agree with a disputed accounting principle. So this is when they start pounding on tables with the auditors. You can't do this. Yeah, I can't do this. This is you know what? You're not the only auditors. I'm going to find another audit firm who's smart enough to know that this is the way you should be doing it. Okay, so they go around. They call up an audit firm. We'd like to do our audit. Are you interested? Yeah. Okay. By the way, the previous auditor said we couldn't do this. Is that something you guys are going to have a problem with? That's shopping for, and this is actually very frowned upon by the AICPA, that someone would call around and try to find a sympathetic CPA firm to some disputed accounting rule. So shopping for accounting principles, this is a bad thing. So they're trying to get, and client continuance is simply, do we want to keep going with this client? And, if you have a client that's really a nightmare, you may say it's not worth it. Okay, let's stop here. And when we come back from break, let's start in on the sampling overview. So let's say be back at 657, 707. Okay. And we'll start with some sampling overview. Okay. Um, the general purpose of sampling, and we talked about this before, is to take sample of items and project it over the entire population. So and we do this, you can actually get a very high level of confidence around something by taking a lot of times a very small sample relative to the entire population, taking those and then projecting over the population as a whole. And they do this in a lot of things. Usually it's more efficient. One of the reasons why we do it in auditing is it's much more efficient. We, instead of taking all 100,000 accounts receivable, we can get 99% share by taking 1,000. So a lot of times it's more economical. There are some times when it'd be completely impossible to take an entire population. For instance, if you had a medicine you wanted to test out, you can't get all 8 billion people on the planet to take your medicine. So you start with a small group, and if it goes okay with that group, then you take a little larger group, and finally, okay, it's going to work with 42% of the people, so we'll project it over the entire population. It'll help 42% of the people, or whatever it is. And for auditing things, like I always use the example of inventory for Walmart. It'd be completely impossible to take the inventory for Walmart. A physical inventory, 100% physical inventory at the end of the year for Walmart would be impossible. So sometimes it's through necessity that you can't take the thing as a whole. But yeah, the reason we usually do it in auditing, though, is it's much more economical, and you can get fairly high, a fairly high confidence that your sample is going to be good, by taking a fairly small amount. Okay, a random sample. This is the best. And this is the best because it is unbiased. Okay, a true random sample is unbiased. And it gives our best estimate of the population as a whole. So we use random number tables, and you can also use random number generators on the computer and that sort of thing. But a random sample is the best one. And if you can, they're a good one to use. They're the best one to use. Okay. The next best, let's say second best, is a systematic selection. A systematic selection, I'll give you an example, it's probably the easiest way to explain it, is that you systematically choose the items. And I'll give you an example. So for instance, you pick every 10th item. So maybe you have a random start, you start at item number 3. Oops. And you go 10 from that, 13, you go 10 from that, you go 23, go 10 from that, yeah, you get the idea. And this is the second best. It's not quite as good as the random sample because it could be possible that, you know, the 5th item every month is the one that has a problem. And if you're not picking the 5th item, you'll never find the problem. So there is it's not the best, but it's not bad either. Yeah, so this would be an example of that. You know, pick every 10th item. Okay. Haphazard selection. This is when I don't want to say randomly. It's just by the auditor haphazardly, I guess. Haphazardly. Let me give you an example. Is there a synonym for that? Chaotically. That's a good one. Example. Closes their eyes and pulls items. Okay. So auditor goes to the filing cabinet, closes their eyes, and pulls out 10 items or however many items that they need to pull out. The auditor closes their eyes and pulls out. So you go over to the filing cabinet, you close your eyes, and you take 10 of the folders out, and those are what you audit. Now, haphazard has a real problem when it comes to auditing. Everything in auditing must be repeatable with the same result. Not necessarily the same judgment, but the same result. Now, choosing the sample is something that needs to be able to be repeated. So haphazard is generally not used unless at a last resort. Actually, I did use it once, and I'll tell you why. But anyway, haphazardly is not a preferred way of picking it, because if I close my eyes and pull 10 items out of the cabinet, and my supervisor comes and says, "Oh, how do we pick the sample?" Well, you close your eyes and pick 10 items. It's highly unlikely that the audit senior is going to pick the same 10 items that I pick. And picking the sample is an important one. So picking the sample randomly, either random number table or randomly generated on a computer, that's the best one. Systematic is okay. the senior can come and take every 10th item and they'll have the same items that I picked. Haphazard is not. So, haphazard kit is not a repeatable way of picking it with the same result. Okay. The last one that we'll talk about that we can, is something we can do. And this is when an entire block, this is the worst one, by the way. There's a saying that block selection is for blockheads, but getting personal about it. Okay, block sample is when an entire how I want to say this. Entire defined group of items are picked. And let me give you an example. Okay. So an entire defined group of items that are picked is a block selection. Example, all sales for October are chosen to project the total sales for the year. Let's say for the year. What's the problem with using October only to project the sales? So block selection is when you take an entire sample of one thing and say, okay, we're going to use this for the entire sample. So let's just look at October. What's the problem with taking October for projecting the sales for the entire year?
There might be like some sort of seasonality involved, so it wouldn't be like an accurate representation of sales.
Exactly. It could be something, it could be inaccurate because of, October isn't like most months. And there are some places, yeah, that are seasonal. There's some businesses that make, 80% of their sales are made in December. It's just, there are businesses that are like that. So it probably is a representation. Also, a lot of times fraud happens at the end of the year. Near the end of the year, they go, oh man, things are not going well. We got to do something. So if you're taking October, it's not going to catch that. And there could be other things going on in other months that have no chance of being picked. If you have a problem in August and you're taking October, there's no chance of that being picked. So it's not a very good way of doing it, and most places won't do it. It is repeatable. It is systematic to an extent that, your supervisor could come in and take all of October sales, and they should come up with the same, whatever you come up with. But it's just the sample itself is a problem. It probably is not representational. And also, because it eliminates so many items that, from the possibility of being picked, it most certainly is not going to be representational anyways. Okay. So this is the worst one. I've never done a block sample, and I never will, unless someone told me to. So you want to do these first two, and haphazard selection. I had a really weird experience with an audit one time. I was doing an audit of invoicing. This was at US Steel, and I did this audit of invoicing. And US Steel used to have armies of people that would do invoicing. I mean, they had like hundreds, if not thousands of people, huge rooms. I mean, rooms that went on for 300 feet, by 100 feet across, and they'd be all filled with these people with these adding machines. They didn't have computers back then, and they didn't even have calculators, but they had these adding machines, and they would do these invoices. And anyway, as time goes on, they get more and more efficient. They're doing it on computers, and it's all computerized for the most part. There's still some interaction with, people interacting with it, having to change things on for certain reasons, invoicing and all that, but very few people. So US Steel, they have giant buildings. If you're working at US Steel, finding office space is not a problem. There's hundreds of feet of office space. So I go to do this audit, and all the people are in this office area and this one end of the building. And I go in there and I'm doing the normal audit stuff. I'm filing the audit report, the audit program that tells you what to do, and I'm going through that. And it's not a problem. And then I get to these kind of like exception audits, exception invoices. And I say, so I get these exception invoices, and they go, oh, you got to go down the hall. I go, okay, well, it's a big building. I don't know, maybe there's a hole. So I went down the hall, and I can hear people talking like crazy. They talk, laughing and all this stuff. And I go into this room, and it's really far down the hall. I mean, it's literally hundreds of feet from the other people. And there's a woman in there by herself. And she's talking to herself. She's laughing, and she looks at me, and she gives me this kind of strange look. And I asked her, I said, okay, well, I've got these items that I need to pick, from, I had this random list out, and she just kind of looked at me and smiled, and she kind of said something, and I don't really know what she said. And I said, well, where would I go to find it? I realized that she was I kind of knew that she was a schizophrenic, like seriously a schizophrenic. And she would just start talking and laughing and singing, and sometimes she'd yell about something, and and I would try to talk to her, and it just nothing. So here I'm sitting with this list, and so I go, okay, well, I'm going to look at these boxes. Well, the boxes aren't labeled or anything. So okay, I started looking through them. I can't make heads or tails out of it. So I go back down the other end. I said, well, what is this? What's going on? And they said, well, she's a schizophrenic, and it's a union job. They can't make her take her medicine. And I guess she's going to retire in like a year or something like that. They said, and she wanted to be down there. She didn't want to be with us. And, that was fine. And anyway, she's down there by herself. And so I go back down there, and I'm trying to figure out how this is all going together. I can't figure it out. So I call my supervisor, and I'm like, look, I don't know if anyone told you about this, but we have this problem, and I don't know what to do with it. And they said, well, you pick. I think it was like 40 items. So okay, go pick 40 items. Do it. Open up. Whatever, 10 different boxes. Take 4 items out of each box. Test those, and we'll have to use that as. And again, there probably was a system. I could not figure out how these were being filed. So I did, closed my eyes, picked out, did that. And the kicker to it is that they were perfect. Every single one of them was absolutely perfect. And these were the tough ones. These are the ones that you expected to find errors in, and they were perfect. And one of the things I kind of know now about schizophrenia is that it often hits people who are very intelligent. And she was obviously very intelligent. She obviously knew her job. She could do that perfectly. But, she's off her meds and or whatever I don't even know what they were giving her. But anyway, so that was the only time I ever picked a haphazard. And it really affected me. And I can remember seeing her drive out of the factory, and I was still doing stuff on this audit. And I went back to the office and I said to one of the people, I said, well, I saw her driving. What, is that safe? And they're like, well, she's super intelligent. Yeah, she can drive. Isn't a problem. And I was just, okay, I didn't know. I didn't know how much they're. But anyway, that was the time I had to pick a haphazard sample. It was a very strange one, but and nothing came out of it. I mean, there wasn't anything wrong with any of the ones I picked. So, okay, stratification. Stratification comes from the idea that basically all accounts are not equal, and that there are ones that are more interesting than other ones. So we have a partial list of accounts receivable. 10 items here. And looking at the first 10 accounts, which one of the accounts receivable will be most important for the auditor to verify? Which account or accounts are they going to be most interested in?
The two bigger ones, like 5 and 6?
Yeah, probably 5 and 6. 5 and 6 certainly, maybe even 2, but certainly 5, and 6. They're the larger ones. So these two are probably going to be the ones that they really want to take a look at. They have the biggest dollar amounts. And so, yeah, you'd more run. And if you look at some of these, like number 3, even if the whole thing was off, it probably wouldn't matter. You're talking about $28 versus almost $1 million. So, number 3, if number 3 was off, you wouldn't even care. Well, not that you have a bad attitude, but it probably wouldn't matter too much if number 3 was off completely, 100%. Whereas these, if they were off, it could seriously change it. Okay, so the bigger ones are probably the ones you're more interested in. Which of the accounts is most likely to be fraud? Kind of an odd one. Which account is most likely to be fraud? Which of the accounts when you look at it say, well, that's kind of strange? Anyone? Oh, throw it a guess. Somebody. Which one of those accounts really looks kind of unusual?
Number 3.
Could be number 3. What I was thinking of is number 6. It's very strange to have transactions that come out to be nice round numbers. Is it possible? Yeah, it's possible. But it's very unusual. Probably number 6 would be the most likely to be fraud. One of the weird things about fraud is that it's often done in nice big round numbers. My guess is that it would be so that people who commit it can keep track of it or something, but it's a very strange thing that a lot of times fraud will be 5,000, 10,000. I remember there's a fraud that they defrauded the government, and the two people that defrauded it each took exactly, this was in pounds, this is a British company, but they took exactly 5 million pounds. Like, here's a check for $5 million even. Not 5,123,262.52 but nice big round numbers. And that is a kind of red flag. Usually business transactions don't happen that way. Can they? Sure, but it's sort of unusual. And those are usually when you scan through accounts receivable, that's going to be one that's going to jump out and say, okay, I want to look at that one. Okay, so here's what we do for stratification of the sample. We take a sample and we break it up. So we say, okay, anything that is, say, over $10,000, we will audit that at 100%. And if it is, say, 1,000 to 10,000, we're still interested in those, just not quite as interested. So let's say 20%. And those that are, say, under 1,000, again, we're still interested, but not quite as much. And so that would be 5%. So this is where we take stratification, for example. We make strata. We make different levels for them. And again, the reason is because larger numbers are generally more interesting to us, because if they're off, it has a bigger impact on the financial statements. So this is stratification of a sample. And the way you would do this is actually over 10,000 is actually not a sample. You're taking 100%, so that would not be considered a sample for that strata. For these next two, these would be samples. Oops. And whatever level you audited those two, would depend on the number of items you picked and all that. So anyway, so these are the how you kind of stratify this, especially if you're trying to pick a random sample. That a random sample will say all these are the same, whereas actually you are a little bit more interested in the over, the larger numbers. You're more interested in the larger numbers rather than the smaller numbers. Now notice that every item is still available to be picked. Even the $28 one here can be picked. It'll be under the, it's got a 5% chance of being picked. So everything has a possibility of being picked, but the larger ones we're more interested in. Question on that? All right. Yeah, we'll go through these. We'll go through this one shouldn't take long. Types of audit sampling. Attribute sampling. Attribute sampling, this is generally done for tests of controls. It's actually important. By the way, actually, I'm going to highlight this one. This is probably the most tested on the CPA exam. attribute sampling. I'll tell you why in a second. But yeah, so attribute sampling for attributes. Okay, these are yes/no tests. For example, was the purchase order signed? Yes or no. It either was signed or it wasn't. These are used for testing controls, tests of controls. And tests of controls are done to determine whether you can rely on controls. There's some letters out here. Testing controls are used to determine whether the auditor can rely on the client's internal controls. So testing controls are everything like, by the way, this ties into what we were just talking about. No, not that. This ties into this up here. You know, this control risk. This is what they're talking about. Test the controls. We use test the controls the Chapter 6 handout, the control risk. We want to know if we can rely on these controls. We're going to assess them, and we're going to assess them by doing these attribute sampling. This is a binomial test. So in auditing, or excuse me, in statistics, they talk about binomial samples is what they're talking about. If you actually look at the binomial samples in statistics, I may have already talked to you guys about this. Did I talk about the central limit theorem? Maybe I did. Most samples can be estimated using the normal distribution central limit theorem. I'll tell you why this is important to us. The actual chunking away of the numbers of binomial distributions is really difficult. You generally do it on computers, and it's very heavily oriented in that. However, it is possible to get an estimate of it using the normal distribution, which is virtually what everybody does. Nobody actually uses the binomial distribution numbers when they do testing of controls. And I'll show you what I mean by that. Wait a minute, I gotta turn some lights on here. Okay. What it basically means is that any kind of sample you want, when you run it more than once, it can be, it'll be similar to a normal distribution. For example, binomial, for what we're doing it is yes, no. Did someone sign the purchase order? Yes or no? It's sort of like flipping a coin. Okay, so let's do one flip. Okay, it could be heads or it could be tails, right? And there's a 50% chance of each one of them. So this would look like, that for distribution, basically be a flat distribution, be sort of like one or the other. If it was a continuous one. Okay, let's take two flips. Okay, now if you don't care about the order, it looked like this. It's possible that both flips are heads, right? It's possible that both flips are tails. It's possible that the first one's heads and the second one is a tail. And again, if we don't care about the order, it's also possible that it could be a tail and then a head. So it is possible you get one of each. There's two chances of that happening. So this would be a 25% chance, this would be a 50% chance, and this would be a 25% chance. So even after just one flip, it's 50-50. Two flips, if you don't care about the order, and for what we're doing, we don't care about the order, that you have one head and one tail is 50% chance. Two heads are 25 and two tails are 25. You can see even after just two flips, it starts to become a normal distribution. And this is true for most distributions, that they will end up being. Now, look like Dracula now. Now the beauty of that is that now we can use the normal distribution to pick our samples, which is much easier to use than the binomial distribution. There's tables that you can do very accurately, and that you can actually get a very precise and controlled picture of whatever you're doing using the central limit theorem to basically use it as an estimate of the binomial distribution. And quite honestly, and even if you get to some bigger numbers, and I don't know if it's still true, but in a lot of cases, it's more accurate because there's no rounding. You get the rounding of the binomial distributions. Okay, so the central limit theorem is great because we can use the normal distribution to pick our sample, which means we can be fairly efficient, fairly accurate, very accurate, and pick a good distribution of it. Okay. Discovery sampling. This can come in a couple different forms, but basically it is for what we do and for looking for fraud anyways, how many items can be picked without an error to determine okay, let me give you an example of that. For example, say without errors. Maybe you have a 80% confidence in that there aren't any errors in the entire sample. You go up to 100 items, oops. Without errors, well, you're a little more confident now. Maybe you're at 92% level. And you go to 200 items, maybe you're at, I don't know, 98% level. You know, so the more items you go without an error or an exception, the more confident you are. So that's discovery sampling, the way we use it. It can also be used to look for error rates in the total population. That if you pick 500 items and they have 3% errors, what's the total upper limit on the errors for the entire population, things like that. But you're basically looking for some kind of a discovery of something that has gone wrong. And a lot of times if it's used for fraud, it's either there or it's not. Okay, classical sampling we did. This is the mean per unit. Ratio estimation. And difference estimation. And monetary unit sampling. I'm just going to leave that because we already did that. That's what we did the last time on the, oops. That's what we did, you know, monetary unit sampling is just monetary unit sampling. That's what we did last time for sampling. Okay, dual purpose test. So let's say we have this situation. Oh, by the way, these are sampling for variables. In other words, it could be off by $1, $2, $3. It could be a variable amount what they're off by. So this is not sampling for attributes. This is sampling for variables. And these two are to find. Actually, there's a whole bunch of stuff in here. I gotta put more stuff in here. These are called substantive tests. And these are tests for material misstatements. And both of these are for tests for sampling for variables. These are dollar amounts. Is it off by $10, $10,000, or what's it off by? Okay, so I'm going to move discovery sampling. Because I want to get these two together. So attribute sampling and classical sampling, sampling for, sometimes called sampling for variables. It's a type of sampling for variables. You get dollar amounts. So these two are for dollar amounts. Sampling for attributes is not about dollar amounts. These are yes/no tests. So was the purchase order signed? Yes or no? Now, if the purchase order wasn't signed, does that mean the purchase order amount is in error? So
No.
it could be a perfectly good purchase order. It just wasn't signed. The controls weren't good. So a lack of controls does not necessarily mean the financial statements are misstated. Test of controls, attribute sampling, cannot find material misstatements. Can't be used for material misstatements. It doesn't look at material misstatements. It just says, are these controls being used? Now, you say, well, okay, well, why do we even do them then? Well, we do them to reduce the amount of substantive testing. If you can determine whether these internal controls are working, how much can you rely on them, then you can reduce your substantive testing. So the whole purpose of testing for internal controls is that you can reduce the total amount of testing that you do. All right, but you cannot use test of controls to say the financial statements are misstated, because even if the controls aren't followed, these are yes/no tests. They don't give you a dollar amount. And even if the controls aren't being followed like they should be, it's possible the financial statements are fine. So keep that in mind when you find a material weakness in internal controls is not necessarily a material misstatement. So if there's a material weakness in controls, they have a real problem with controls, does not necessarily mean that the financial statements are misstated. But the reason for us doing it is to reduce these. Let me put that in. So if you find you can really rely on these internal controls, well, then you can reduce, your what they call substantive testing. So this is why you do the test of controls. I should probably, it is attribute sampling, but let's do that. So test of controls, they reduce your substantive testing. Okay. Okay. I'm going a little late here, but hopefully not by more than a minute or two here. Coming down here, dual purpose test. So you're picking a sample, and let's say that for test of controls, we need 100 items. And for the substantive testing, whichever one we use, classical or Monterey unit, let's say that we need 500 items. Okay, so we got to pick random samples. So we pick a random sample of 100 items for the test of controls, and then we have substantive testing, we need 500 items. It would be smart to use the 100 items you picked for test of controls. You've already picked them. All you have to do is look at the dollar amounts and use those in the substantive testing. So here is what we would kind of end up doing is the 100 items we picked for the test of controls, this will be our so these aren't really lined up very well, but you get the idea. So dual purpose, we'd have 100 items from the test of controls we'd also use for the substantive testing, and then the new items we would pick we would simply need to pick 400 more. So dual purpose testing is really just an efficiency thing. It's like, okay, you've already picked the sample of 100 items. So coming down here, where you need to have 500 items, simply take the 100 items from the test of controls and add another 400 to them, and then you have your 500. So a dual purpose test is that. It's using the same item more than once, and it's for efficiency. You don't have to do this, but it would make sense to do it. And since you already got the items pulled and you're looking at them, all you got to look at for substantive testing is the dollar amounts, that they're much easier. So it makes sense that you would use that same 100 items for the substantive testing. Okay, we'll stop there. Questions on any of that? So that's kind of how it all fits together. And this is when you find your risks, this is how you mitigate them. This is how you do the test of controls. Can you rely on the controls? If you can reduce the substantive testing. Classical or monetary unit, whichever one you're using. If you can't rely on the controls, then you just have to go all to substantive testing. But again, this is when you're looking for the risks. Any questions on that? Okay, I'm 2 minutes over. Actually, I think I started like 2 or 3 minutes late. So really, the net amount is that I'm early, and you're welcome. No, any questions on that? Okay, I think that the test is due. I know some of you already turned it in, but the test is due this Friday. So see if you can get that in the chapter 3 exam. Any questions on anything? Okay, I'll go quietly so in case you guys are sleeping. Good night.